So it's 2026, and something pretty fundamental has shifted in the world of American finance. An asset that used to be on the absolute fringes, Bitcoin, is now at the very center of serious financial conversations. Today we're going to break down exactly how that happened, step by step.
Let's just start with the headline, the main takeaway. Here in 2026, Bitcoin isn't just some speculative bet anymore. No, it is now treated as a strategic U.S. financial asset. And that right there is a massive shift from where things were just a few years ago.
Right. So that immediately begs the question, a pretty big one. How on earth did this happen? How did an asset that was once seen as a total outsider become an insider talking point in the most sophisticated financial system in the world?
Well, here's how we're going to tackle that. First, we'll talk about what it even means to be a strategic asset. Then we'll get into the big institutional shift and the real reasons behind it. After that, we got to talk about ETFs. They were a total game changer. And finally, we'll put it all into context for you.
Okay, so let's kick things off by defining our terms. When we say strategic asset, what are we really talking about? We're talking about a complete change in perception, a move from something that traditional finance basically ignored to something it now studies for its unique place in a modern portfolio.
So what was the real driver behind this institutional shift? It wasn't just one thing. It was actually a bunch of factors all coming together that really forced these big U.S. institutions to take a second look at Bitcoin. Let's dig into the three main reasons this all happened.
And here they are, the three big pillars that got institutions on board. First, it's fixed supply. You just can't make more of it. Second, it's deep global liquidity. And third, and this is huge, the fact that it finally got packaged inside products that regulators were comfortable with.
All right, let's talk about fixed supply because this is so important. What it really means is you have predictable, provable scarcity, but in a digital form. Think about it. Unlike traditional currencies, they can just be printed and printed. Bitcoin has a hard limit, 21 million. That's it, full stop. And in a world where debt keeps piling up, that kind of mathematical certainty, well, it starts to look really, really appealing.
Okay, so let's build on that idea. In the world we're living in, here in 2026, some of Bitcoin's core features have become super strategic. It's a global network, not controlled by any single country. It can settle value without needing a bank in the middle, plus its ledger is totally open for anyone to see. All of this makes it this really unique neutral asset, especially when there's so much global friction.
And this table just perfectly captures the huge mental shift that happened inside these institutions. The whole conversation changed. What used to be written off as just gambling on the price, now it's seen as a hedge. What was just some niche tech thing, now it's viewed as a kind of portfolio insurance. And that outsider network, well, now it's being treated like a piece of foundational digital infrastructure.
Okay, but all this institutional interest is great, but how did they actually start putting money into it? Well, that brings us to the key, the mechanism that unlocked everything, the spot Bitcoin ETF. This was an absolute game changer. And this just lays it out so clearly. The before and after is like night and day. Before the ETFs, man, for a big fund to invest in Bitcoin, it was a total headache. So much friction. You had to figure out complex custody. The compliance rules were super murky. But after the ETFs, it was like a bridge was built directly to them. Suddenly, they could get exposure using the same old brokerage accounts they always use, through providers they trust, with clear rules. All that friction just gone.
And the effect was, well, it was immediate. This simple, regulated on-ramp was like opening the floodgates. It just pulled Bitcoin straight into mainstream finance. All of a sudden, the risk committees at these big firms could give it the green light, financial advisors could actually recommend it, and these massive pools of capital could flow in using their standard models.
All right, so we've covered the why institutions got interested and the how they got access. But there's another piece to this puzzle, the when. Why is all this happening now in 2026? Well, it really all comes down to the asset's journey to maturity.
I mean, if you just step back and look at Bitcoin's history, it's really a story of growing up. In the early days, it was super volatile, totally experimental. Then it went through these massive market cycles, and with each one, ownership spread, and the network just kept proving it could survive. So by the time we get to 2026, the whole infrastructure built around it is established, it's mature, it was ready for prime time.
And this chart gives you a really good visual for what that maturity actually looks like. If we track three key things, the trend is crystal clear. First, volatility. Yeah, it's still there, but it's generally calmed down from the wild swings of the early days.
Second, you can see institutional ownership has been steadily climbing. And third, the regulatory picture has gotten so much clearer. You put those three together, and you see an asset that's moved from being an experiment to being something established.
Okay, so why does any of this matter to you? What's the takeaway? Well, it changes how the market works. Now, you'll see market moves reacting way faster to things like US policy signals. In the long run, having all these big players involved might help smooth out some of those extreme boom and bust cycles we used to see. And honestly, it just provides a much clearer framework for understanding why the market is doing what it's doing.
Look, if there's one single idea you take away from all of this, let it be this. It sums up the whole story perfectly. Scarcity built the interest, regulation enabled the access, institutions followed the capital logic. It's that simple. The unique scarcity got people interested. US regulation built the bridge. And once that bridge was there, the big money just followed the logic.
And all of this leaves us with one last, really fascinating question to think about. See, Bitcoin isn't just an asset anymore, it's being treated like a piece of core financial infrastructure. So the big question for the future isn't if it's going to be used, it's what new, incredible things are going to be built right on top of it.